I'm Jennifer Nevin, and today I'm joined by Jeff Carter, a portfolio manager at Kansa Investment Counsel. Thanks for joining me today, Jeff.
Thanks for having me, Jen.
Now, in the most recent version of the Market Observer, it talks quite extensively about inflation. We know inflation expectations are a major variable when it comes to bond investor decisions. So I'll ask you this: what does the market expect for future inflation, and what implication does that have on investing in today's bond market?
That's a great question, Jen. One of the first places we look to for inflation expectations in the bond market is the U.S. Treasury Inflation-Protected Securities Market, otherwise known as the TIPS market. TIPS bonds have two return components to them. The first being that your principal, which is due back to the maturity, is adjusted along the way for inflation measured by the Consumer Price Index, or otherwise known as CPI. The other return component of the bond is just like any other bond, it's your coupon, and that coupon pays based on the current principal balance at the interest payment date. When we look at the TIPS market, it implies inflation expectations of about 1.8%. Often people in the market refer to that as the break-even rate. When we compare the inflation expectation of 1.8% versus the actual measured CPI in the market, which has recently been about 2% or just above 2%, that's a difference of about 20 basis points. And so when we look at regular U.S. Treasury bonds or nominal Treasury bonds, say for example a bond with a 10-year maturity, that U.S. government bond currently has a yield of somewhere between 1.8 and 1.9%. So certainly that's close to the inflation expectation of what the TIPS market implies, and it's actually below where the CPI is measured. If you look at Canada, that comparison is actually even a bit more pronounced. Currently, Canadian government bonds are trading with yields approximately 60 basis points below the actual measured Canadian Consumer Price Index inflation rate. And so what does this all mean for bond investors? Well, if your real yield or your actual purchasing power is being eroded away by the rate of inflation, then one would ask, why would I go and buy government bonds? And there's a couple of answers for that. First being that there's a subset of investors, institutional investors, such as endowment funds, pension funds, or other financial institutions that have a need, and either actuarial or regulatory requirement to hold government bonds, regardless of what inflation expectations are in the market. For investors that have a voluntary choice in terms of whether to hold government bonds or not, they need to assess the risk of holding these bonds in the face of inflation. So if you look over, say, the past 50 years, the chart here displays a measurement of US CPI, represented by the red line, versus 10-year US government bond yields, depicted by the blue line. Now what's striking about the chart is how very few time periods nominal bond yields held below the rate of inflation. The period of inflation shocks through the 1970s was crushed by Federal Reserve rate increases and a corresponding sell-off in the bond market, resulting in higher yields. The following 25 plus years leading into the financial crisis was characterized by a rallying bond market, but one which traded at healthy spread versus inflation, which allowed investors a reasonable real or post-inflation return. The environment that we have today, where government bonds are below actual levels of inflation and expected levels of inflation, is not the norm. And certainly the implications for that would be an investor who has bonds that have a longer duration, they're more exposed to potential declines in the value of their bonds should we have an increase in yields relative to the rate of inflation we have in the market today.
Well, thank you for your time, Jeff. For more information on inflation and Kansa's market insights, please go to the Kansa Funds website and read the latest edition of the Market Observer.